In the first year of owning a home, the average buyer spends $86,698 on top of their down payment and mortgage. Not in total, on top. That number comes from a 2025 survey of over 1,000 homeowners, and the most alarming part is not the figure itself. It is the fact that nearly nobody sees it coming before they sign. You probably have a number in your head right now. A monthly payment, maybe a rough estimate of property taxes. You did the math on a calculator, the agent smiled, your family sent congratulations, and you held those keys like proof that you had figured it out. Here is what nobody mentioned. The real annual cost of homeownership runs between 40 and 60% higher than what most buyers actually calculate. And according to American Home Shield's research, 46% of first-time buyers admit they did not understand the true cost before purchasing. That gap between expected and actual is not shrinking. It is getting wider every year. There are 5 things your mortgage calculator will never show you, and by the time we go through all of them, you will understand exactly where that money disappears to. When most buyers sit down to calculate their monthly payment, they treat property tax as if it were a parking fee, a fixed, predictable number that just sits there quietly year after year. They find the current annual figure for the home they want, divide it by 12, add it to their monthly payment estimate, and consider that box checked. What almost nobody tells them is that in most states across the country, that number is not fixed at all. Property taxes are reassessed regularly based on the current market value of your home, which means that when the housing market moves, your tax bill moves with it, whether your income does or not. Consider what happened between 2020 and early 2025. The national median home price climbed from $303,400 to approximately $437,942, a rise of nearly 44% in just 5 years. In most states, reassessment formulas track that appreciation directly, and millions of homeowners opened envelopes to find bills that looked nothing like the numbers they had originally budgeted around. In 2024, the median property tax bill reached $3,500 nationally, but that average conceals an enormous range depending entirely on where you bought. Homeowners in New Jersey pay a median of $9,413 per year in property taxes alone. Homeowners in West Virginia pay $728. That is not a small regional variation, that is the difference between a manageable line item and a payment that rivals a car loan. According to Bankrate's 2025 Hidden Costs of Homeownership study, 26% of first-time buyers did not realize their property taxes could change over time. That statistic describes what researchers call tax assessment shock, the specific moment, on usually arriving 2 or 3 years into ownership, when a reassessment letter lands in the mailbox with a bill that runs 20 to 30% higher than anything the buyer originally modeled. Different states handle reassessment in completely different ways. Some reassess annually. Some reassess only when a property changes hands. Some cap annual increases at a fixed percentage. Almost nobody researches which category their state falls into before they sit down at the closing table, because the brochure never mentioned it was something worth asking about. If property taxes are the slow leak in the boat, then what is happening to homeowners insurance right now is something much closer to the hull cracking open. That hull is cracking faster than most people realize, and it is not giving anyone a grace period to adjust. Nationally, insurance premiums have surged between 30 and 40% over the last 5 years, according to analysts at Yale E360. In Florida specifically, the average annual premium jumped by $1,450 between 2020 and 2023 alone. Not a gradual drift upward, but a significant single-chapter increase that arrived without warning on renewal notices across the state. The reason this is happening sits entirely outside any individual homeowner's control. In 2024, the United States experienced 27 separate weather and climate events that each caused more than $1 billion in losses, with total damages across all of them reaching $182.7 billion, according to the National Oceanic and Atmospheric Administration. Insurance companies do not absorb those losses quietly. They recalculate their risk models, reprice their entire books of business, and pass the resulting increases directly to policyholders, including policyholders whose homes have never been touched by a single weather event in their lives. A California homeowner who purchased her house in 2021 described opening her renewal notice to find her premium had simply doubled with no prior notification whatsoever. Her neighbors had received something worse, letters informing them their coverage had been cancelled entirely. They told her she was lucky. That framing, where doubling your insurance bill counts as good news, tells you almost everything you need to know about where this market has gone. The Zillow and Thumbtack 2025 analysis found that insurance premiums have risen 48% nationwide since February 2020, and that in Miami, the average annual premium now sits at $4,607, up 72% over just 5 years. Meanwhile, roughly 14% of owner-occupied homes across the country are currently uninsured, according to LendingTree data, a figure that climbed more than 6% between 2023 and 2024 alone. Some of those homeowners cannot afford the premiums. Others in the highest risk zones have simply been dropped by their carriers and cannot find replacement coverage at any price. This is not a regional problem contained to Florida and California. More than half of all single-family homes built since 2010 are located in areas with elevated wildfire risk, and 7 of the 12 largest insurers operating in California have either exited the market or significantly reduced their coverage since 2022. The exposure is spreading, and the industry is repricing accordingly. There is also a quieter version of this crisis affecting homeowners who believe they are fully protected but are not. Many people have not updated their coverage limits since the day they closed on their home. The cost to rebuild a damaged home that ran $166 per square foot several years ago now runs closer to $300 per square foot, driven by pandemic-era inflation in construction materials and labor. And that means a policy that once would have made a homeowner financially whole after a disaster would today leave them covering hundreds of thousands of dollars in rebuilding costs out of their own pocket, while still paying a premium that has already doubled. So we have talked about costs that grow quietly in the background. Now let us talk about the one that shows up every single weekend with a to-do list you did not ask for. The real estate industry has a standard rule of thumb for maintenance costs that gets mentioned briefly in closing paperwork and almost never discussed in the actual conversation leading up to it. Budget between 1% and 4% of your home's value every year for maintenance and repairs. On a $450,000 home, that translates to somewhere between $4,500 and $18,000 annually, and Guardian Life data suggests the realistic figure for an average-priced home sits much closer to that upper end than most buyers want to believe. That same Zillow and Thumbtack research put the typical American homeowner's annual maintenance spending at $10,946, which means maintenance alone costs more than property taxes and homeowners insurance combined. It is the single largest hidden cost category in homeownership, and it is also the one that feels the most random and the most unfair because it does not arrive on a predictable schedule. According to Guardian Life, 83% of homeowners experienced at least one unexpected maintenance issue in 2024. Unplanned repairs are not the exception in homeownership. They are the operating assumption. Here is the part that never makes it into the listing photos. When you tour a home and fall in love with the kitchen counters and the hardwood floors, you are not seeing the HVAC system that is 11 years old, the water heater that has been running for 8 years, the roof that has 14 years left on its manufacturer warranty, or the electrical panel that was installed to meet code requirements from a prior decade. Those systems are invisible during the buying process, and they are expensive when they fail. What makes this genuinely dangerous from a financial planning perspective is the cluster problem. Most systems in a home of a given age were installed around the same time, which means their useful lifespans tend to expire within the same general window. The family that buys a 20-year-old home is not buying one ticking clock, they are buying several of them, all set to roughly the same alarm. Bankrate's 2025 research into hidden homeownership costs, which measured everything a homeowner pays beyond the mortgage, arrived at a national average of $21,400 per year. Maintenance is the largest single driver of that number, and it is the one cost category where the gap between what buyers expect and what they actually spend is widest. But for about 1 in 3 buyers purchasing a new home today, when there is another monthly charge waiting for them that did not exist a generation ago, and it has been quietly growing every single year. If you are shopping for a newly built home today, there is a better than even chance that the community it sits in is governed by a homeowners association, and the odds of that have been climbing steadily for over a decade. According to the Foundation for Community Association Research, approximately 67% of newly completed homes in 2024 were part of HOA communities, compared to just 49% in 2011. That means most buyers purchasing new construction are automatically entering into a financial relationship with a governing body that has the legal authority to charge them money, fine them for violations, and in some states foreclose on their property if they refuse to pay. And many of them do not fully read the documents explaining any of that before they sign the paperwork. The median monthly HOA fee reached $135 in 2025, up from $108 in 2019, and in states like Florida, those figures climb considerably higher, with HOA costs representing the largest share of monthly housing expenses in many of the country's most HOA-dense metro areas. A homeowner paying $200 per month in 2020 who experienced just 5% annual increases would be paying $255 per month by 2025, an extra $3,300 over 5 years before accounting for a single unexpected charge. That last phrase matters, because beyond regular monthly dues, HOA boards have the authority to levy special assessments whenever a major unexpected expense hits the community: a new roof on a shared building, emergency structural repairs, replacement of aging common area infrastructure. Homeowners have very limited recourse once these are approved. The bill simply arrives. It is worth noting that 57% of people currently living under HOAs say they dislike the arrangement, according to a Rocket Mortgage study, and 1 in 10 has actively considered selling their home specifically to get out from under their association. Those are not idle grievances. That is a significant number of people who feel financially trapped inside a purchase they cannot easily undo. All of these costs are real, measurable, and documented. But there is one more cost we have not mentioned yet, and it is the only one that never appears on any invoice. Every cost we have covered so far shows up somewhere eventually, on a tax statement, a renewal notice, a contractor invoice, or an HOA ledger. This one never does, which is precisely why it is the most overlooked of all 5. At current median home prices, a standard 20% down payment requires roughly $87,500 in cash. The moment that money is transferred at closing, it stops being a liquid financial asset and becomes equity in a single illiquid property. It cannot be moved, diversified, or redeployed without selling the home or taking on additional debt. From that point forward, it earns returns only in proportion to how much the home itself appreciates in value. That same $87,500 placed in a different environment would behave very differently. The S&P 500 has returned approximately 10% annually since its inception. On at that historical average, an $87,500 investment in a broad index fund would grow to roughly $227,000 over 10 years without a single additional contribution. Research published by the Association for Financial Counseling and Planning Education found that the net annual return on homeownership, after all carrying costs are factored in, tends to run closer to 2% in real terms, essentially breaking even with inflation over time. The gap between 2% and 10%, compounded across a decade, represents a genuinely significant difference in where a household ends up financially. It is important to be precise about what this argument actually is and what it is not. Homes provide something that an index fund cannot replicate: stability, permanence, and the freedom to paint a wall or tear out a kitchen and rebuild it exactly the way you want, and the social and psychological anchoring that comes from belonging to a place. Those things have real value that does not appear in any rate of return calculation, and dismissing them would make this analysis dishonest. The opportunity cost argument is not that renting is smarter than buying. It is that $87,500 is a genuine financial sacrifice with a measurable alternative, and that sacrifice deserves to be acknowledged clearly before the papers are signed, not glossed over in the excitement of the moment. So what does all of this actually add up to? And more importantly, what are you supposed to do with it? Here is what the full picture actually looks like when you add everything together. Bankrate's 2025 research into hidden homeownership costs found that the average American homeowner pays $21,400 per year beyond their mortgage, covering property taxes at a national median of $3,500, homeowners insurance running between $2,003 and $4,607 depending on climate risk exposure, maintenance averaging $10,946 annually, HOA fees where applicable, and utilities on top of all of it. In Hawaii, that total climbs past $34,000 per year. What this means in practical terms is that the true all-in monthly cost of owning an average American home today runs somewhere between $500 and $1,000 higher than whatever number a standard mortgage calculator showed you. The way to protect yourself from that gap is straightforward, even if it requires more work than most buyers are willing to do before closing. Instead of running a mortgage affordability calculation, run a true cost of ownership calculation. Take your full PITI, principal, interest, taxes, and insurance, then add 1 to 2% of the purchase price annually for maintenance, add HOA fees if the property carries them, and make sure you have a separate emergency maintenance fund of at least $5,000 to $10,000 sitting in accessible savings before you hand over a single dollar at closing. The buyers who get crushed by homeownership are rarely the ones who could not afford the mortgage. They are the ones who could afford the mortgage but had not budgeted for everything the brochure quietly left out. Knowing the real number before you sign is not a reason to walk away from the purchase. It is the reason you will be able to stay. If this video gave you something the brochure did not, consider subscribing. Because every video on this channel is built around the same idea: the information you actually need, delivered before the decision, not after.